Thank you, ma'am. Senator Kim.
Yeah, thank you, Chairman. Thank you for coming before us today. You've often said in the past that when it comes to monetary policy that it works with a lag, right? That this is something that you're having to try to assess the data that's before you.
Right.
I'm thinking about this because we have the Federal Open Market Committee, FOMC 5-year review, and you were talking about tariffs and the uncertainty of this moment. So I guess I just wanted to ask you, how do you balance sort of assessing between more of the backwards-looking data that you're able to look at more tangibly in that way, but also addressing sort of forward-looking models to try to understand where things are heading?
That's really the challenge that all forecasters have, and really monetary policy needs to be forward-looking. At the same time, we need to be humble about our how hard it is to forecast. So, particularly at times of high uncertainty, which I would say I would include now, you really want to look at the real data and take signal from that, and not be too brave about what your forecast might be, because it's going to be highly uncertain.
So you're saying that in times of greater uncertainty, in some ways that makes you more interested in the backwards-looking data to sort of guide you?
Well, I'd almost flip it around. Yes, but I'd almost flip it around and say at a time like that, you don't want to be giving a lot of forward guidance, and you don't want to be acting as though you have a lot of certainty about the path forward. It makes sense to move more slowly in most situations where there's more uncertainty. There are situations where it would not make sense to move slowly, but in most cases, you'd want to move more slowly.
Yeah, that's interesting. I mean, I talked to some of my constituents back home. There's this one conversation I had that has really stuck with me, where a woman was telling me that there's so much uncertainty right now in the world and certainly in her life that she says it's hard for her to even breathe sometimes. She just feels this kind of weight upon her chest. And I've thought about that a lot, because I try to think through what can we do to try to alleviate that concern, alleviate that anxiety for people. But you can see it. I mean, right now, whether it's about what's unfolding in the Middle East and the fragility of what comes next. When I look at this reconciliation bill before us in the Senate, I do worry not just about the deficit, as some of my colleagues have mentioned, but about the potential of significant job loss that we're seeing, whether in the healthcare industry, whether in the energy industries. And certainly when it comes to tariffs, as you said, trying to think through what comes next in terms of whether deals are struck and at what levels. Are you taking into account that by sort of an issue-based level, or are you looking at sort of the global instability in terms of the different crises that are out there? Is that factoring into how you're thinking about when we're talking about legislation here? I know you're not going to go into the policy per se, but if there's a potential for significant job disruption, is that something that you're looking into as you're forecasting?
Yes. We obviously pay great attention to global events, and in an effort to understand what's going on in the economy globally, because that does matter for our economy. So we pay close attention to all of those things and track them. Ultimately, though, we're looking at the U.S. economy and what are the fundamental drivers here, and then making a judgment based on all of that. And mainly, this is a big economy, and we're geographically separated from most of the other big economies in the world. So we have a smaller external sector than most of the all the European economies, for example. So we're really looking at the U.S. and what's happening here.
I wanted to ask you, because in central banks in other countries, including Bank of England and European Central Bank, they've begun modeling the potential macroeconomic effects of artificial intelligence. They're thinking about how they can use AI to be able to do some of the forecasting, to think through what comes next. I guess I wanted to get a sense of what the Federal Reserve is thinking in terms of similar work in the AI space.
We have lots of people doing work on AI, and more than that, even monitoring research that's going on everywhere in the world. And speaking of uncertainty, it's very clear that it has the potential to make really dramatic changes in our economy, in our workplace, in the jobs of workers, in the way companies work, and all of those things. But it honestly, there's a tremendous uncertainty about the timing of that, and what the ultimate consequences will be, and what the medium-term consequences will be.
I was wondering if the Fed is evaluating AI credit models and how that could potentially deepen disparity in credit access or violate fair lending standards. Is that something that you've looked into at this point? And
Yes, absolutely.
is the Fed looking to potentially affirm some industry standards on this?
You know, it's something we've been aware of for a long time. There's a lot of research that's been done. Before generative AI came along, it's also just machine learning and technology generally. You need, there are implicit biases that can appear. It's something we're very well aware of, and you know, we do work with people to make sure that that doesn't happen.
Okay, thank you. I yield back.